Time to see what's on the radar for Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. And we were talking about it briefly before the break, but Dollarama, you're liking that, Brian?
Yeah, we've liked it for a long time, Roger. I think I've owned it probably in every portfolio I've managed since about 2010 or 2011, which is not long after their IPO in, I think, 2009. It's a real homegrown success story. Started with one store a long time ago. It was owned by private equity and then did the IPO in 2009. Bain Capital was the private equity sponsor. But what we're dealing with now is the dominant dollar store franchise in Canada with 1,700 stores. It's ubiquitous. It's almost synonymous with the category. But about 10 years ago, they planted some seeds via a joint venture in Latin America. That's now grown to about 700 stores. They're just on the cusp of having entered into Mexico in the last quarter or two. They own 60% of that joint venture with more of the economics for Mexico, which, needless to say, is a huge addressable market that's lightly contested. And so they have the game to get after that very capably. And then more recently, they, via an acquisition, acquired TRS, which is a terrible name, by the way. It stands for the Reject Store.
Is that the Australian one?
Yeah. So that's the leading dollar store format in Australia. This one, candidly, is a bit of a fixer-upper, but it's a great platform from which to both fix up the existing store footprint in terms of merchandise assortment and in-store experience, and bring the margins up to scratch and the sales productivity per square foot up to Canadian standards and create tremendous value that way. What we like about it is it's got exposure to this sort of K-shaped economy because it is by far and away the low-cost leader on pretty much any single item that they stock. I mean, we were mentioning off-air, they've got lip balms for $3 that Sephora sells for $35. That's just one of about 4,000 examples because they stock about 4,000 items.
Can you do a little comparison for us on those two?
You need them in this cold weather we're having. So they have exposure to that sort of strapped consumer. But interestingly, unlike in the United States, the retail concept actually does resonate across income demographics. You'll find Ferraris and BMWs and Porsches in the parking lot.
People know they can go there for certain things, too.
That's right. And it's different in the States. There's a bit of a stigma. The concept skews more rural than urban. That's not the case for Dollarama. So it's a broad-based concept with national resonance. It's a capital light growth algorithm. It's about $2 million to open a store, and the payback period is very, very short. So that allows them great free cash flow, which they use to buy back their shares and increase their dividend. Never been a cheap stock, but it has had a pullback in the last couple of weeks. It trades at about 35 times earnings, down from close to 40 going into December, mid-December. And so we think that's pretty reasonable given the long runway of growth in front of them in 3 geographies now, and the likelihood of them compounding earnings growth at about 15% over the foreseeable future.
And no real concerns about local challenges going into those new markets?
No, because they're lightly contested markets. They're basically pioneering the concept in the LATAM markets. So first mover advantage with a lot of experience gained over decades in Canada. And then they've acquired a platform where they are the largest of, admittedly, a not great competitive set in the dollar store format in Australia.
And are they going to keep that name?
No, they're going to rebanner it, thankfully, to Dollarama, but they're not going to do it until they can do it with pride. That is to say that those stores physically and merchandise assortment and price point-wise rival the experience the shopper would have in one of their Canadian stores, which, we applaud that decision. By the way, this is another one of these family-led companies like we talked about in the earlier segment.
All right. And let's take a look at Linde PLC.
So this is quite a different concept altogether. This is a massive behemoth.
It's the helium for the balloons at Dollarama.
Yeah. I suppose it must be. It is a big leading industrial gas and engineering company. So they're a supplier of things like oxygen, nitrogen, helium, rare gases, and so on. And they serve customers in food and beverage, healthcare, electronics, energy and chemicals, metals and mining, manufacturing verticals. They have very sticky long-term take-or-pay contracts that typically have commodity cost pass-through, so that insulates their margins from some of the commodity price sensitivity and volatility. Their customers have high switching costs because their facilities are usually located inside the walls or inside the premises of a customer's manufacturing plant or other facility. High operating margins, north of 30%, high returns on invested capital, north of 25%. All this creates a lot of free cash flow, about $11 billion worth. About half of that goes to reinvesting in the business, and the other half goes split off between share buybacks and dividend increases, and they are a serial dividend increaser and buyer of their own stock. Shares are trading at about 25 times earnings. That's roughly in line with its 5-year average. One of the things we like about this, although it is a materials company with an industrial exposure, you'd think it would be sort of cyclical. It's not particularly. They have great visibility into the business. They've only missed their earnings guidance once since the first quarter of 2020. So, it's just a big, wide, competitive moat company that's indispensable, mission critical for their customers. And so we like that kind of visibility and
built-in demand.
What ostensibly looks like a commodity business, but actually has a fairly wide moat around it.